and life. So, welcome to Small Talks. For people who are joining for the first time, a quick introduction about Small Talks. We talk to people who've kind of built in the startup ecosystem or anywhere else. We try and understand a unique culture blend that people come from. We try and understand how did they build their career in unique ways and industry trends around it. This time we kind of have Digant, who's the co-founder of Incentive, has had two exits from other companies that he's built. Super excited to host you, Digant, with this. Just quickly giving you the mic, if you could give us a quick intro, and then we dive right into questions.
No, pleasure being here, Krishna, and great that we sort of went sort of solved the issues that we had before joining this call. But is there? You can hear me, right? I think there was a little
Yeah,
bit of.
yeah, yeah.
But to give you a little second introduction about myself, I'm the co-founder of Incentive, a brand, a company based out of Bangalore, where we're solving essentially, we're sort of building the private infrastructure for private equity through a bunch of products and tools that we've built, whether it comes to fund management, private equity secondaries, ESOP management, or advisory. Right? So we build solutions across the board for founders, investors, employees, shareholders, name it, in the private equity ecosystem. This is about my fifth stint building something. So I've had two businesses that I've sold before this, ran an agency, worked as freelance, worked in corporate, worked in a startup. So I've pretty much done it all with respect to my early career, having been worked around in different places. And currently, we're working on a very, very solid problem statement, or in fact, a bunch of problem statements at Incentive. And it's been 4 years that I've been doing it. And yeah, here we are. Happy to take this conversation and sort of shed light on a bunch of things that we're doing, have done, etc.
Perfect. So let's dive into the first question, right? A lot of people, at least in my organization, the current place where I work, constantly keep coming and asking us questions about ESOP day to day, right? Like, let's start with that itself, right? What are the top three or four things that I should know as an employee about ESOPs? If I am being granted a ESOP in a company, what are those top three or four things?
Sorry, I think I lost you there. What are the three or four things you need to know about
Yeah.
ESOP? Is that the question?
Yes. As an
Yeah, I
employee,
think,
if I'm
see,
joining a new firm and I kind of get, say, 2 lakh rupees ESOP or in different value sets, right? 3,000 shares, for example. What are those top three or four things that I should know as an employee when I'm accepting those ESOPs?
got it. Um, See, I think on a very fundamental level, you can hear me, right, Krishna?
Yeah, yeah, I can hear you.
I think. Okay, I think I lost you there for a second. But anyways, what I was saying is, see, on a fundamental level, you've really got to understand what the instrument is before you get to the other things that you want to know about ESOP, right? Firstly, you need to understand that ESOP stands for employee stock option. The P stands for a plan, but it is interchangeably used with stock options. So stock options are nothing but a derivative instrument where essentially you have given a right to own equity in a company at a future date at a predefined price, right? So basically, when a company gives you stock options, they're essentially telling you, hey, here is an agreement that we are both signing. So it has to be signed by both of us, where eventually over quarters, years, etc., the right that I'm giving you to own equity in the company is going to unlock. When that right does unlock at a predefined price, which is called as a strike price or an exercise price, you can convert that into shares. What it is on a fundamental level. Now, then you add various different layers and parameters to it. You add your vesting schedule, which is basically
Yeah.
which answers the question of, okay, how
So we'll just stay on the link. I think Dekan just lost his net. Yeah.
I think something happened. I'm so sorry for this.
No
There are
problem. No
power
problem.
cuts, there are internet outages, a lot of things. But
Goodbye.
we'll get through it. We'll get through it. Um, did you get the part where I was talking about what stock options are, the
Yeah,
fundamentals of
so
it?
yeah. We went through like strike off prices, future date, like X
The
price
strike
set, and you can
price,
kind
yes,
of
yes, yes.
invest. Huh. Yeah.
So that is a fundamental thing that you got to know, right? But once you get past that, then comes the more critical questions that you need to answer.
Hmm.
What is one
Yeah.
is eventually the right is going to get unlocked, so stock options are going to get vested. But when is that going to happen? So first
Yeah.
thing that every employee needs to know is that until 12 months, you don't really get
Hmm.
anything, which is called the
Correct.
cliff period, basically within which if you leave the company and go, you don't get anything in the company, right?
Yeah.
So even if you have, there are cases where employees have worked at companies for multiple years and the founders have said, hey, we're going to give you stock options, but they've said that verbally, and then
Yeah.
later one day they just remember, hey, we have not given them stock options. This employee is thinking of leaving in a few months, and they're asking where are my stock options, and they create ESOP plans and they give grant letters, and then they
Yeah.
realize that if the employee leaves within 12 months, they don't get anything. So
Yeah.
that creates those issues, right? So that is one. And post the cliff period, is it going to be monthly, quarterly, or yearly? How does it
Yeah.
get vested? Is very
Yeah.
important to know. Uh, Simple things like, okay, I'm getting 3,000 shares in this company. What is that as part of the fully diluted share capital? So the company needs to sort of tell
Yeah.
you, okay, this is basically 0.1% or 0.5% or 1% of the company's
Yeah.
cap table, essentially.
Yeah.
You also need to know at what valuation you're getting the stock options. See, and why that is relevant is, see, if a company has really raised at a very high multiple, for example, a lot of companies that raised in 2021, 2022 at super high, company
High
valuations.
valuation. Yeah.
Essentially, what happened to the ESOP is the value of the company went down, hence the value of the ESOP also went down.
Yeah.
So a lot of employees had actually exercised the stock options of these companies at a very high valuation back in 21,
Yeah.
22, and they paid those taxes, and the company's value went down. Essentially, that to write the whole thing off, right?
Yeah.
And third is when we're talking about tax is very unforgiving. You really can't do much about it. You
Yeah.
as much as you can, all you can do is essentially maybe exercise your stock options early when the company's valuation is low, and then
Yeah.
hold it for a couple of years, and after 2 or 24 months you end up paying long-term capital gains on anything that you make, right? So
Yeah.
that is
Yeah.
the only way you can reduce the amount of tax, because the perquisite tax, which is essentially on
It's
31,
insane.
is very
Yeah.
high, right?
Yeah.
And the sad part is you pay tax on no cash that you've ever got. You have essentially, all you have
Yeah.
done is you have converted your stock options into shares, basically
Yeah.
exercise that, and the government just comes knocking on your door and says, hey, you got to pay taxes immediately upfront.
Yeah.
Not, you can't wait until the end of the year either. You got to pay it immediately.
Hmm.
So what most companies do is, when you tell them, hey, I want to exercise my stock options and get shares, they're like, okay, you pay me my exercise price of 10 rupees per stock option or whatever it is,
Hmm.
and then you pay me this 30%, which could be lakhs. I've even spoken to
Yeah.
employees who had to pay 40-50 lakh rupees in perquisite tax, and they were like, dude, I don't
Yeah.
have this money, so I think I
Yeah.
might be letting go of all these stock options that I worked so hard
Yeah.
for. So
Yeah.
more than
I
four
think
things is
very
what I meant.
common.
So these are
Yeah, yeah, very common. In fact, this is one thing which even I at one point did not know, right? Like while I was building ESOP policies for people, giving grant letters out, this exercising schedule is very crazy. But now I think there are companies who are giving leeways for exercising, right? You can decide to exercise till the time you leave the company. At least most companies are doing it. Even after you vested, till the time you're in the company, you can keep doing it in parts if you want. So I think that's one relief for most of the people. But like you said, right, people just assume that yeah, okay, if the policy is not in place, not a problem, we'll just later on speed up the vesting. But that cliff period point, most companies forget as early
Yeah.
stage startups, and I think most employees suffer because of that. There's one more very critical angle. There are different types of buy-ins, right? Like the investor can buy in from you if in case there's liquidation, they can buy it from you, right? Like for employees. But I've seen that a lot of companies are not comfortable with secondary buy-in as an option, where
Mhm.
employees can sell their stocks, or like even say angels can sell their stock. I think you'd written an article about this, and that's how it kind of landed on your page. If you can kind of shed light on that, according to you, why do you think the market is still very touchy about secondary as an option to be given to people?
See, it's actually multiple reasons. I think the most first principles statement would be, firstly, the company is more, their main business is their business. A founder's main job is his job at the end of the day, right? Raising funds, yes, is something a founder should be very into and interested in doing, but that's where the intent usually ends, because there's so much work to do in a company. So when it comes to secondaries, what essentially happens is your employees or your shareholders, they sell their shares, whatever, to an external investor, and they get the money, and the transaction is between them. No rupee hits the company, so the company does not
Correct.
have any real material benefit out of it.
Hmm.
However, the management still needs to spend time with whatever compliances. They still need to update their register of shareholders. They still need to probably sit on calls and understand who this incoming shareholder is going to be, give them information, waive off the ROFR, do a bunch of these things, right? Whatever filings they've got to essentially file. Why
Hmm.
would they put so much effort if they're not getting material cash benefit out of it? That is the
Hmm.
first principles, first statement. The answer to that is usually going to be, so whenever an investor usually invests in a company, so there are multiple ways why how you can answer that, right? So a lot of investors, when they invest into a company, usually in the term sheet, or usually in the term sheet, they do mention an exit period of sorts. It could be 7 years, 8 years, 9 years, depending on the stage, depending on the kind of investors,
Yeah.
depending on the situation you had.
Yeah.
Uh, so the closer you get to that period, the more the questions get asked from the investors, saying, "Hey, any idea about buying back, or any idea about giving me an exit?" Because usually the terms would have been, "Hey, at this specific number of years, once that passes, either we will buy it back from you at the most recent fair
Yeah.
market value, or what fair market value we're going to ascertain at that point, or we will enable you to sell it to somebody else." Basically saying, we'll help you
Hmm.
sell. Well, like, or if you want to sell, we'll enable that. So that right of a shareholder is intact. The right of the shareholder to sell is always intact. So if the shareholder does want to sell, the company has to, in some way, not restrict it, because otherwise it goes against the shareholders' right. And then the argument to that comes that the company does not want just about any shareholder to come and sit on the cap table.
Yeah.
They might
Yeah.
not want retail investors to come and sit on the cap table, because
Yeah.
they want to maintain some accredited status in terms of who
Yeah.
sits on the cap table. They might not want a competitor's related party to come and sit on the cap table,
Correct.
someone snooping around. They might
Yeah.
not want to have certain shareholders with whom they've got, maybe don't have good relationships, or who are investors, or in another competitor, anything of that
Yeah.
sort. They might have whatever reason it is for the kind of
Hmm.
investors that they want, and every
Yeah.
founder will have that.
Hmm.
Now, all these things, now the same thing applies for employees as well, right? So employees might have very small stakes in the company. Employee might have 10 lakh, 20 lakh, 30 lakh rupees with the stock
Correct.
options. You might have 50 employees or 100 employees with that many stock options. If all of them now start selling to different sellers or different buyers, you're now adding 100 or 50 new shareholders to the company's cap table, these small
Yeah.
ticket holders, 10 lakh, 20 lakh rupees. You don't want that, essentially.
Yeah.
Right? So that will really call as clutter the capital. So there are various reasons why the companies don't want to do it, right from the effort that
Hmm.
they've got to put in, to the kind
Hmm.
of transaction and the kind of people. So our
Hmm.
solution to that as incentive was that we will completely eliminate the amount of effort that you've got to do by streamlining at the entire process. So we have
Hmm.
our standard operating procedures. We have ways to collect data. We have ways to sort of enable these things to
Hmm.
happen.
Hmm.
And then we ensure that the consolidation happens at the transaction level itself. So you've got 50
Hmm.
people, 20 people, 10 people. No matter how many people are selling, we ensure that a consolidated number buys it. It could be one, could
Hmm.
be two. And usually these could be investors that are more in line with what the company wants. So we've
Hmm.
seen all these various different issues that companies say no to secondaries for, and which has
Hmm.
prevented a lot of people, a lot of ESOP holders, shareholders, and even a lot of
Yeah.
founders themselves who sell equity. And we've figured out answers to that, which could be turned into real solutions, and built a
Hmm.
process and a solution around that,
Hmm.
which is what gives incentive the edge, because incentive is the full stack of that solution in one
Hmm.
platform itself.
Infra for the backend, basically. Yeah.
Infra for a lot of things, but even for secondaries, we're building the
Hmm.
proper infrastructure for that to happen.
Hmm. Got it. I wanted to actually come to another, like you just mentioned, founders, right? You have co-founders in this organization, well, as well. I'm assuming in other stints also, maybe you may have had co-founders, right? How did you go about finding your co-founders or interacting with them, right? Because this is a very critical decision, deciding to build something together, right? You're having money together. As soon as finances get involved, it's very tricky, right? And also, does your vibe match with the other person? Will you be able to pull the strings when required? How did you do that math for yourself?
So before incentive, pretty much most of the things that I built was all solo. I had so I had like a partner in a couple of those businesses, but most of them were just solo, right? They were not private limiteds; they were more LLPs and sole proprietorships, which became decent sized businesses that I could sell. So it also made it easier for me to sell and transfer the ownership deed of those businesses. But that is how I've run businesses before this. It was just me with a laptop in my house, which serendipitously scaled, right? And But this time was different. So the way we built this company is with me and my co-founder Ranjit, my first co-founder. We were college mates, and then we've been in touch after college as well, where he was doing his own thing and I was doing my own. And we essentially connected over this specific subject of entrepreneurship and doing our own businesses. And that's where we sort of bonded. And over conversations, over different meetups, and that we did, we sort of landed on specific problem statements that we thought we could solve together. And those conversations, ideas led to us actually going and building something. And where he had to stop what he was doing, and I had to stop what I was doing, which were both our own independent businesses and projects that we were running parallelly, right? And then we went head on. We met our co-founder actually at a co-working space where me and Ranjit we would just buy day passes and go. That's where we met him. He was working as a co-founder in another company, and we sort of convinced him to join us. And very recently we've promoted our CBO as a co-founder as well. So Chetan, who sits out of Mumbai, and Chetan connected to me on LinkedIn after having seen one of my LinkedIn posts about 3 years ago. And then we worked with CP for a while, and then because of the tremendous work he did, he kept on rising within the company and is now a co-founder as well. So apart from me and Ranjit, the other two co-founders, it was all happenstance of being at the right place at the right time, and literally like doing the work. And that's generally what how you meet a lot of people. And
Yeah.
in fact, even go back 4 5 years, right? And one of the biggest things I would think to myself was like, I want to build a lot of things, but where do I find people to build? And back then,
True.
the answer that even I had seen a lot of places is, they say go to events, go to cafes, go to co-working spaces, meet people. And I'd
Yeah.
never really believed in that. But now that I answer this question and I'm looking back, I'm like, yeah, man. I mean, that is kind of how at least 50%
Yeah.
of our founders are, have started working with incentive that way itself. Uh, but now it's getting even easier, in Bangalore, and even in most places. Then the number of events that happen, the number
Yeah.
of co-working spaces that are there
Yeah.
for you to meet like-minded people that you can vibe with, that you
Yeah.
can build something with. It's easier.
Yeah.
In fact, there are groups and there are subreddits that I've been seeing where they're literally subreddits where people come and look for co-founders and stuff. So
Yeah.
uh, it's easier that way, I feel, today as opposed to 4 5 years ago even.
Yeah. In fact, while I kind of recall, I and Jay also met through a network, like a community. We both were part of it. One led to another, and that led to forming this. And yeah, at least like all tier one cities, you have crazy networking events happening every week. Bangalore, for that matter, I think happens every day. So that's another level of
Yeah.
crazy. But even other places like Mumbai, Friday, Saturdays are like pretty common. Like I think one of your co-founders is in Mumbai as well, right? For
Yeah.
one such similar event.
Fun
Yeah.
puzzle. Yeah.
So with this, I also wanted to ask you one question, but completely off what we were speaking so far, right? And this is a problem statement which I kind of try and ask most of the leaders I'm working with in today's day. Productivity has become very subjective with AI, right? Today, with the kind of tools that we have, I think each person is capable of doing at least 3x, 5x, 10x more depending on how they're using tools, right? How are you seeing this pan out in your organization or around? Because you speak to a lot of other founders as well, right? How is this being played at like this point in time?
So our org, what's happening right now is we have three verticals in our business. We have a very small team. We've got what I think 15, 16 people only in, and this is at scale we are at 15, 16. I think maybe we'll add another 3 people, 3 4 people maximum. And we've been able to do this. We've been able to build an ESOP management tool, which is really really good at really out there, and we're just launching a fund management product. We have a secondaries platform. We have an advisory business, ESOP design and valuations and all of that. The way we've been able to do this is because the team has been able to really leverage. It's at least the engineering team and the product team has been really been able to AI to the max. Otherwise, we would probably need a 40-member team for the scale size that we're running and the ambitions that we have with the kind of products that we are putting out there, right? So, from a application perspective, engineers know best how to really use it to sort of clone them 3x or 4x and be able to do things that they would have take a lot more time, and they more or less need to function like architects and understand what they're building, but understand whether the direction is correct. So they're more directors rather than the ones who are building it in core. From a GTM, from a business and a marketing perspective, essentially, the application of AI is a little more nascent with all the conversations that I'm having, right? Video AI is still very new. Video AI is still not crossed the uncanny valley, so people are still using it very. They're using it very carefully. Video written material is been overused. If you just been on LinkedIn and you read and you get emails and that you see.
Gyan sab jagah ho gaya. Yeah.
Within the first two lines, you know if it's AI written or not. You kind of see the patterns of the way people are writing. So standing out from that just requires you as a human to get back to using your brain and writing, and maybe using AI to improve. But that's it. When it comes to sales, when it comes to marketing, yes, AI is definitely something that you can use. But from a productivity perspective, the biggest problem that I'm seeing, and in fact, I have a lot of friends who I usually speak to at least on weekends about these concepts, right? One of the things that founder that I met last weekend, he was telling me is, dude, like a lot of people use AI all the time to get from inertia to information. Okay, basically what that means is, let's say you want to start a crazy sales campaign for a product that you want to launch. From having just that idea in your mind to getting a 90-day playbook, you'll use AI. And then that PDF will sit in that chat of yours, because it'll be a 15-20 page PDF that AI would have generated. You'll just glance to it, be like, I'll read this later. It'll sit in your chat. That's it. It'll never be executed. And then the same thing will happen for another idea and for another idea and for another. So AI gives a lot of people a false sense of productivity where they're like, actually
instant gratification.
Instant gratification, right? I turned 10 ideas into PDFs which are executable. So utna to ho gaya na kaam. Like you feel like it's not just an idea in my mind anymore, but the execution is where very few people still do it, because execution still requires the human element. You can't automate too much of execution. Right? And if you do completely automate, it's all going to be AI slop. It's really not going to land anywhere. So using AI is also making execution worse. So that's my,
One thing which I also realized in the past couple of weeks is, now everybody is able to do the 80-90% work, right? True talent now lies in the last 10%. You will be able to collect all kind of data, like you said, right? But that last mile 10%, how you're executing or when you're executing, I think changes the game for most of the people in the ecosystem, right? Also, one thing which I've seen as a flavor, that major adoption has been on generative AI side so far. We are still not there from the agentic standpoint, right? Really sloppy prompts that are being given to these generative AIs, right? Then, and also generative AIs don't have opinion. It is not going to give you opinion, right? So then it becomes like a very neutral play that you're playing all throughout. I'll give you one quick example, right? I was hiring one person in my team on the community GTM side. Interviewed around 10 people for this role. 7 people had the same answers for the assignment we sent them. So now we've started adding one more line. I would love for you to use LLM, but please put your brain in that. Do not copy paste and send whatever GPT gives you.
No, that is a valid point. Actually, that is for those who want to continue using their brains and really having that edge. I think even with a responsible use of AI, this is something even I do because I write so much. It could be very easy for me to just ask AI to keep writing stuff. In fact, I've tried doing it, but it has never crossed even past my first review. It's always been just not in my tone,
It's
genuine at all.
gibberish, and it has no opinion, like just flat whenever
It's
you kind of
basically
ask
so
it
it's
to be.
basically pattern recognition. So it would have seen a bunch of
Yeah,
patterns that it thinks it works well, and then it puts it out of context and mixes them together, which doesn't really work together. But the problem is not even that. The problem is when the answer to any problem you have in your mind, and the solution first is to go ask AI to give you the answers. That
yeah,
essentially what it does is it relieves you of having to use your own brain and your own creativity. So
yeah,
you don't even get into the exercise of putting pen on paper or putting your words into a notepad or your notes or somewhere and writing your ideas down,
yeah,
which makes us fundamentally dumber over time. Like
yeah,
if you just use calculator for math, even for double-digit numbers, you
yeah,
eventually you stop,
yeah,
having the ability to count or to
yeah,
multiply and add. Right. So same way, a lot of people are not. So the antidote to that is at least the front end part. You do it yourself and then use it to refine it over time. Like if you're writing
yeah,
and if you're writing a newsletter, you're writing a blog post, you're writing something,
yeah,
maybe it is give it the framework, maybe write for shorter form content, write it yourself, and then maybe help it improve it wherever you think it is, and then you improve it again and then post it, like something like that.
yeah,
Just relying it on it to create everything for ideas, just relying on it to create strategies. Like a lot of people
yeah,
use it to create their entire business strategy. Just does not work. It usually sucks. It's horrible, right? And
yeah,
if you are relying on it blindly, it's your fault, and someone else who's not relying on it blindly could sort of outcompete you because they're using the human
yeah,
brain.
yeah, yeah. With this, now that we're like on founders topic, in the past also, there's one question which I wanted to ask you, right? Which is that one most common myth founders tell themselves about the company's valuation or cap table.
About the company's valuation or cap table. I think one good thing that has happened, and bad thing for a lot of founders earlier is back 3 years back, your valuation was purely defined on your idea. Your valuation is
Hmm.
purely defined on if the TAM and SAM and SOM and all these, how big your market is essentially, or how big you could sort of uh, showcase your market as. Not
Hmm.
anymore, right? So the times have changed now. Your valuation is not defined by how big your market is, because what's happening is a lot of people can enter the market. The entry barrier for products, then the entry barrier for of executable business is very very low, because now you have a robot to do it for you, a lot of thinking for you. Good and a bad thing, right? Which means a lot
Yeah,
of sloppy products are going to come, but that
yeah,
aside, um, so execution is the only general metric that a lot of people are going to be using for your revenue, and that execution would be, wait, have you been shipping products at a right rate? Have you been able to make revenue? Have you been able to hit the targets that you've wanted to? So a lot more pressure is going to come on founders for the real fundamental way to value a company, which is pure revenue, which is revenue growth,
hmm.
and other metrics, more logos added as customers and actual profit. So those
Hmm.
metrics, rather than our market is growing and this and that and
Hmm.
all that other crap, right? So that is one. So the whole misconception of, hey, I have a great idea and I have a big enough market, hence I need a big valuation, just won't fly, right? And eventually, what's going to
Yeah,
happen is another thing that we're going to be able to see is when a lot of people can build products and a lot entry barrier is even lower. People who have already done things before, people have built businesses before, people have had some kind of success, some kind of exits before, etc., will find it easier to sort of raise money or
yeah,
to be new business, because they've sort of seen a cycle where an additional tool was not there or did not exist. So they have seen cycles where it was all them against their competitors, right?
yeah,
Without AI or without anything.
yeah,
So that is the biggest
yeah,
conception with valuation. Like valuation is no longer conceptual; it has to be tangible with numbers on the
yeah,
books.
yeah. And I think distribution also has become like a moat now. A lot of
Yeah,
businesses
yeah,
will be driven by distribution. I think
100.
most founders, I think the biggest delusion which I've seen when we speak to multiple people offline, right? They're like, we've had X amount of downloads, we've had X amount of unique visitors, and those kind of vanity metrics. And I'm like, how does this convert to revenue? Like, are we speaking about that, right? When are you going to hit a beta positive? I think that's where most of us are failing as founders when we're building. So that also I think needs to be done better. With this, coming towards one topic, that is exits, right? A lot of founders build and then want to exit at the right time. You've kind of had two exits under your belt. What did you do right the second time regarding equity that you wish you knew in your first stint itself?
So see, my case was slightly more unique because, like I told you, right, it was a one-person business. I did have employees. So basically, I had uh,
But becomes
assistants.
more critical for you, right? Because you're like, you were that one man army, like, and now in at least in the Silicon Valley, it's become very common, right? There are four people team who scale to like $1 billion business and take exits, right? Were there any learnings from the equity angle? Because you did kind of take an exit from those organizations, right? Any key
Yeah.
learnings you had?
So for me, the first and the second exit they happened in a span of about 2.5 to 3 months because I was
Hmm.
running both of them parallelly. So
Oh,
these were
hmm.
more into these were D2C businesses that became white label businesses that then one of them became more of a get distributors and get specific people to distribute the products out of businesses. So one I was into knives. So we would make hand forged knives. So we were selling in the US, and so there I did have my own little warehouse where material would go and sit, and then we did have back orders placed by distributors for a very long time. So then I eventually ended up selling it to one of the distributors itself because they would take these ahead. And the other product was, again, it was more into dash cameras and a bunch of other. It was like 2 3 different products within under one, and that was again bought by another friend of mine who had scale. So we would essentially uh, we'd get these things white label, this specific product white label in China, and we really started building good ground there and making improvements to the product, etc. But the guy I sold it to had far deeper, like he was pretty much living in China half the year at that point, so he
Hmm.
had a better way to leverage whatever I was building. So I ended up selling it to them. So there, my entire learnings from that was like if you're building a physical product business, having deeper integrations in terms of backward integration, having factories that you're working with very closely, having distributors that you're working with very closely, and supply agents that you're working with very closely. If you're working in China, that is, like in India, it would be slightly different. It's very important for you to be able to build a business that you can sell, right?
Hmm.
So there, if you have built those things and if you have those long-term contracts in place, then selling is easier. But if I have to put that into the current business and similar business and product, etc., that you can build, it the same thing holds, right? A company with good distribution first, right?
Hmm.
Like you said, uh, distribution is the mode going forward. Anybody can pretty much build a decent, half decent product, and because a lot of people will be building a lot of half decent products and selling them at a very cheap, close to nothing rate, because now they're one person, two people teams, they can afford to live. If the business pays their rent, their food, and some extra money, they can essentially run the business,
Yeah.
right? You being able to distribute and build that trust and build that brand is very important. So a lot of companies that will get acquired will be acquired based on that and your ability to then service the products that you're selling, which a one person, two
Yeah.
people team find it very hard to do. From an equity
Hmm.
standpoint, for exits, a lot of founders they think about exits either too early from a like at seed series, that is too early for you to generally look at an exit. So either too early from a funding round perspective, if they're going the funding round route, or too early from a revenue and product perspective. A very small revenue, nothing meaningful usually does not yield to any secondary exit, whether it's partially or completely, right? So even in the secondaries business, a lot of companies that we work with are Series B. Usually, Series A is also slightly early for us, but Series B to late stage. And the core requirement there is that the product has matured, the market that they're serving understands them deeply, and they have deep distribution moats, and that's what a lot of investors looking to buy into these kind of companies and buy these shares will also be looking at. One, and they're also looking at companies from an exit perspective. You don't want from founder's perspective, you don't want to have raised with a lot of very strict and stern terms, right? I even wrote about this recently. A lot of founders these days are raising funds because they're desperate to raise funds. They need the funds. They don't. The businesses are not still there yet, but they've now understood they need revenue, so they're raising that one extra round to make a lot of money, and they raise it at very stiff liquidation preferences and all these kind of terms, which essentially during an exit event ends up leaving very little money for them and their employees and the other shareholders, while the investor investing in that specific round ends up taking a large chunk. So you've got to keep a lot of these things in mind. Building a good business always trumps. I mean, that's the most logical,
Yeah.
obvious, cliched answer to give, but that is the first answer itself. But then the second, how you structure your cap table as well.
Yeah, and also, equity has become so fancy or so sexy that sometimes people don't realize that maybe, you taking debt is better than you taking equity and diluting your funds. I think that mindset also will have to eventually change, right? Like, I haven't seen any founder who's more than happy to take debt. Everybody is okay to give equity at that point in time. So, if your product is like really strong, you rather take debt, right? You know that you're going to hit revenue any point in time. Why dilute your own equity? So
So,
that's also, I think,
see, taking debt is actually more risky than equity in some point, because if you take debt
100%.
and you're not able to service that debt, and then it can convert to very expensive equity as well. So
Yeah, yeah.
usually in convertible debentures, that's usually how they would take. A lot of people take debt as their equity could convert at a much higher or at much better terms than if they were to just put that much money into the company. So
Yeah.
if I
Yeah.
then if I put 25 lakhs into a company, I might end up maybe negotiating terms where I at least get 30-40% more equity for that price.
Yeah.
That is one. Second is usually the companies that get debt and should take debt are the same kind of companies which are already making cash flows, enough
Yeah.
cash flow where they have over and above their operating expenses enough to pay back and service that debt.
Hmm.
If you can't service that debt on a monthly or whatever, quarterly or however your terms are for
Payment
payouts,
terms.
you should not take debt, because it will also overstretch your debt to equity. So raising equity will become harder. And then
Hmm.
you now have this debtor who could convert into very expensive equity. It becomes a it becomes
Vicious
a
cycle.
hodgepodge of vicious things that unlock at the same time. And now you're into what trying to firefight for that and taking more debt or figuring out reworking your debt terms, right? So take debt if you can service that debt. Usually, companies that have taken debt, you have at least 2 to 3 years of proper cash flows that they can look at, and they have
Hmm.
at least 12 months or whatever is the length of the term for the debt that they're taking. They have
Hmm.
a proper
That much
roadmap to
cash.
service
Hmm.
that debt. Yes, yeah.
You are building like infrastructure for the PE side of the ecosystem, right? That means you must be like engaging with a lot of these private equity firms, right? In your conversations, have you kind of identified any first one or two red flags that they normally see in the cap table that like a founder might overlook?
Um, yeah. So the biggest thing is if uh, having too many people on the cap table. Like if you
Hmm.
have way too many people on the cap table, 30, 40, 50. So a lot of companies do raise from large
Angel.
syndicates and smaller check writers, which is definitely great, but they usually do it, and sometimes it goes out of control. And I've been spoken to founders who got 70, 80 angels with very small checks sitting on the cap table. Now,
Hmm.
with the new
Hmm.
accreditation rules, a lot of that is going to go away, because in the past, right before the accreditation rules came, anybody could essentially, without having an accreditation certificate of being an accredited investor, could invest into a startup 2 lakh, 3 lakh, sometimes even 50,000 rupees. That's how low we have seen. And
Yeah.
just sit on the cap table as a shareholder. And the
Hmm.
company ends up raising 2 crores and has like 40 people on their cap table, right? So an incoming investor is going to see a lot of this as operational overload on the company,
Hmm.
because each
Hmm.
shareholder, their shareholders, right? There's going to be a lot of things. You can't just because
Hmm.
he's in a small check does not mean their rights are not intact, right?
Hmm.
So the incoming investors, you would usually like you to clean that up before they come,
Hmm.
because if you're not raising a slightly late stage round, that incoming investor will not want to buy them out. They whatever money
Yeah.
they're giving to the company, they'll want it to go to the company's capital account directly and not to buy them out. So they will
Hmm.
expect founders to do a little bit of a cleanup, which is a lot of our clients that we work with for secondaries. They come to us to
Hmm.
clean up their cap table. They have a lot of shareholders who are sitting on it for 2 to 3 years. Smaller check writers who have not now seen about 5 to 10x of that as an alpha, and then they come to us to try to give them all exits, and maybe one shareholder come and sit instead of them,
Hmm.
right? That's the biggest red flag. Not having an ESOP pool today is becoming a red flag for a lot of people. So that has been a very interesting development that's happened in the last 2 years. which was not the case maybe in 2022 and before that. Usually, any VC, any even an angel syndicate, or any investors that are coming after seed round are asking the company to create an ESOP pool upfront, and they invest after that. So on the total number of shares after the pool is created is where they invest in. So that has become a new thing, and they are also asking the companies to create a stock option plan and ask them what are your plans to hire and what are your plans to compensate with equity,
Yeah.
because a lot of investors are understanding that compensating your employees with equity is very important for you to have people who are going to stay and build.
Yeah. Yeah.
Times
At least the
changing.
core team.
At least the core team, and but with
Yeah.
the ways the teams are shrinking, most teams will just be core teams. Like you're not going to
Yeah.
have a core team
But I like
and
the beauty of it. Yeah.
right.
But I think
Uh,
that's beautiful. At least
yes,
for
yes, yes.
early stage startups up till Series A, I think now the new moat is not. I think previously this was one more moat which I've seen when I was leading multiple teams, right? Scaling was considered sexy. Now scaling is
Yeah, yeah.
not considered sexy. Like I've seen this switch in like 5 years. Like back then, we would kind of literally write posts about we've scaled to 100 people in a quarter. It's no more sexy, right? Like people want to now on the funding side want to know that if you have 50 people in your team, how much are you going to ship? So I think that equation also has changed pretty fast. This
And
is the
also
new
a lot
mode.
of, and this is the new mode. In fact, I think it was like probably like last month I was talking to this one guy who's in VC, and he was telling me one of the core insight that he's got is employee to outcome. So if a company has 50 people, when he assesses a company, he's going to be looking at you got 50 people, so you got 50 people salaries to pay. You're taking so
Yeah,
much funding. You've got so much fixed salaries. What are the outcome per employee that you're going to
yeah,
derive? Founders
yeah,
would not even have thought about that. They're like, what do you mean
yeah,
outcome per employee? So that itself
yeah,
becomes the first step. Like, wait, why do you have 50 people if you don't know what each person's outcome is going to be?
yeah,
Why not
yeah,
consolidate that to 20 people or 15 people? So,
yeah.
what's happening? Sad for the hiring and the market. I really can't comment on that, but very sad for that. But what's
No, but
happening
it's
from
not sad, Digant. Like I'll add to it once you've completed it. There's another angle to it as well.
No, definitely. What I mean is like number of jobs might be lesser, maybe, but number of opportunities to build might be more, right?
Yeah,
So a
yeah,
lot of people might end up building their own companies. That's the secondary thing.
yeah,
But what's happening is a lot of companies are now thriving with smaller teams, 5 people, 10
yeah,
people, 15, 20 people. I even know a guy who's running a company. I think they've got 3 people and they're doing about $8 million in ARR or something like that, right?
yeah,
Three team. So Adam Robbins is on LinkedIn. Anybody can check him out. So that's what's happening. What then that means is whoever is building the product with you is part of your core team now,
yeah,
right? It's not there's nothing more core than that, right? So you only have a team of 10, 15 people. Each of them
yeah,
has a lot of responsibility in building. Maybe you might have a 2 people marketing team, a 4 people business team, a 7
yeah,
member engineering team, and maybe 4 founders, and that's your entire company. And you might be
yeah,
scaling it at a very high pace, right? So what that means is every employee that is building this with you, every lever in your marketing team or a engineering team, everybody now needs to own some part of the company for them to feel like, hey, I'm building this with these people,
yeah,
I'm in this for the long run, but when the company makes money, so should I, right?
yeah,
Because everyone has that window now, because we really can't foresee what's going to happen after 5 years or 6 years, right? So everyone's
yeah,
looking at windows of 3 years. In 3 years, how much can I make, right?
yeah,
As an outcome. So giving ESOPs is becoming a very, very important thing, and VCs and
yeah,
investors are understanding that hiring becomes much easier when you give stock options.
yeah.
So not having an ESOP pool is becoming a red flag.
But you know, Digant, also big biases that I see in the ESOP distribution as well, right? Because I've done this multiple times from the company standpoint. I see that certain roles get lesser ESOPs, certain roles get really high ESOPs, right? I think that pay parity on the ESOP side is still not figured out. Like certain roles get under observed or you don't end up paying them that much, and that actually demotivates a lot of them as well, right? Because while they might not know the exact number of what is being given to the other person, but like say for example if you get somebody as a lead today, right, and you're giving them like say 5 lakh or 6 lakh worth of ESOPs, do you really think they're going to put their skin in the game? As simple as that, right? So I think that also needs to be figured out in the ecosystem. With teams shrinking, you need to give more ESOPs as well. You can't continue giving what was traditionally given.
Yeah, no, that's actually a valid point, right? See, a lot of times people sort of mess up this part is because they don't understand how to give stock options. And yes, that parity is not going to be there, and the reason for that is different kinds of roles have different impacts on the company's shipping or their bottom line or any specific functions. Okay, so one is going to be so when we even sort of consult, so we work with a lot of companies who come to us for creating stock option plans and guiding them with how much ESOPs to give for different team members. So one of the core things is you can't just take the split the pie and just give it. It just doesn't work that way. You got to first understand role criticality. So which role are they coming for? How critical are is their role, and how critical are they for filling those shoes? You might have certain people that you just feel like we just absolutely need this individual in our company. We have seen what they do or whatever it is, and we need them. So they're very critical to what you're building for specific things. So you can't lose them. So yes, the negotiation might be more on their part, where they might negotiate for more ESOPs, so you might give them more stock options, as opposed to another role which might be slightly less impact. I'm not saying no impact, slightly less compared to them, or maybe in some terms significantly less as well, where a churn is something your company can handle. It's not going to cripple them. They can handle that churn. But that doesn't mean they don't want to give them equity. They still want to give them ESOPs and give them that skin in the game to be able to participate in the company, is the wealth creation journey that it's on. And over time they will add. So that disparity will be there. I'll tell you otherwise what's going to happen if it's all everything is prorated to salary and everybody gets a fixed flat percentage on their salary and there's no change there. The person extremely critical to that role and really building that with you is going to have second thoughts as well, because they also would want that extra reward. So usually what how a company needs to look at it is from seniority level, from role criticality level, from risk of churn level, and the ability to absorb that risk. So add these things and then you come to a specific range which within which you can give stock options to them, and that is how you're going to sort of have it. And with that in place, it doesn't, employees don't feel like, if you have that framework already created, employees do not feel demotivated or anything of that sort, because they understand how much stock options that they're getting and why they're getting so much. And usually, if not always, it's going to be very generous. You're muted.
Agree and disagree on this point of view, but yeah, you have larger perspective because you've met more people on that side. There's one more thing which I wanted to discuss today, right? And I've been reading a lot about it of lately, right? Like CS. If you're building platforms, CS is your backbone. Once you make the sale, you also have to convert this person year on year, right? You've booked this person for this year, but you also have to make sure that this person stays with you, right? Biggest gaps where I see people struggling today is CS. Like their customer support team are just all over the place as far as platform teams are concerned. Like, what's your experience on this side?
Yeah, I think so. What's the reason for that happening is, in the past, customer support used to be a little better for most companies, because a lot of them would just outsource to large customer support management companies, right?
Yeah,
So but now
yeah,
people are trimming their budgets and they're looking inwards and seeing how we can sort of round robin things and use AI to do a bunch of things, etc., etc.
yeah,
So it's in a transitionary space right now, where CS is going to kind of across the system kind of suck for a while until the tooling
hmm,
gets better. Because what's happening
hmm,
right now is customer support and servicing is, as an industry or multi industries, they're all moving from very human centric, very human heavy, to more bot heavy or more
yeah,
tool heavy.
yeah,
And a lot of things are breaking, but I think it is a journey that you got to take, and a lot of things have to break for the people who are building them to build better systems and better tools, right?
hmm,
So I think once that is done, what's going to happen is fewer people will be able to offer equal or close to the same amount of service for the same number of people. And
hmm,
over time, what's also going to happen is, sadly, the expectations that people have from customer support is also tapered down. Right? They'll be like,
yeah,
maybe I won't be able to just pick my phone and call a real human for just about anything.
yeah,
Maybe email
yeah,
support or chat support is all I get for the first three, until the first three levels before. And that is happening across the board. you can fight it as a founder by having real humans pick calls and offer that support. But how long or how will you be able to do it at scale needs to be sort of seen, right? Voice AI agents are really coming and they're doing a tremendous job. So being
Yeah,
able
they're
to train them,
crazy.
but
I think at least
it's
the
becoming
first
hard.
level calling, yeah, but then see, it's doing really well on the first level calling to some extent. Like, that's the reason BPOs are changing its definition as well, right? Inside sales is becoming more critical than just kind of doing cold calling, because I think that AI is able to do it pretty well. You just give three
Yeah,
standard questions and it's done. Are you interested? Yes or no? And just ask two more questions and pass it on in the funnel, right? So you at least know that this person is going to talk to you and not keep the phone. So that AI is doing pretty good at this point in time. And like you said, right, it's a churn. It will eventually pick up skills on that side of the ecosystem also and start answering in sync as it kind of builds its own memory.
yeah, yeah. That's true.
So
That's true.
with this, yeah, with this, we're almost towards the end of the set. Just wanted to ask you two more questions, and we'll kind of call it a day. At this point in time, you're building your own brand, right? How do you manage your own productivity? And with this, how are you managing life at same time? Because like of recent, we are also hearing a lot of news of sudden founders at 40, 45 just collapsing, right? How are you making sure that you're staying sane in this ecosystem?
Yeah, I mean, for like the scale at which we're building it, the work is a lot, and we are also trying to go very fast. But I think just making time for yourself. What I see a lot happening with a lot of founders is when they're not working, they're usually still doing something. Um, and usually that is something to do with their phone. So a lot of founders have become proper doom scrollers. At least the ones that I know, a lot of them. And when I speak to them, they're like, "Yeah, man. I mean, when I'm done with work, I just need to get my stress off, and I'm just on Instagram or on YouTube all the time." Right. So that's what a lot of people do. Um, but I think long term that's not sustainable. So you've sort of got to have a little bit of a digital detox after work because you're anyways in front of the laptop all day or in front of whatever device
Yeah.
you're using. So if you do only get weekends, I mean, what I do is I make sure that I make time for working out and I make time for these things. Uh, it is still very little, but whatever it is, whatever I can, I try to do it. And uh, I think, yeah, being close to your family and being close to your friends and really meeting them and having that safe space is very important for you to sort
Yeah.
of have that mental detox of sorts, or be able to have that time to rejuvenate. Yeah, a lot of people, I think the biggest problem is that they take way too much stress for way too long without doing anything about it, right?
Yeah.
So I think combating that early and trying to do something, whether it is meditative, whether it's working, whatever is your antidote to that, actually doing it and actually doing it consistently,
Yeah.
not just for one day, once a month. Actually doing it is all that matters. It could be as small as just taking a walk, but
Yeah.
that's where most of us, that's the first wall that most of us can never cross. They're actually doing it part. So
Yeah.
yeah,
You like rightly said, right? Like for me, detox is reading two pages. For you, it may be taking like a
yeah,
quick walk, right? For you, you have to decide what kind of gets you relaxed, right? At that age. So I think it's very
100%.
important with today's time, and not only founders, like even people who are at higher roles, right? They also unnecessarily take stress. Like I'm not disrespecting anybody when I say this, but end of the day, you're supposed to work for living and not the other way around, right? Like we need to pause at so. There's this one person, and I am also guilty for doing the same thing. So I went to my parents' place recently, and then just came back to Mumbai, and I was so fresh, full of energy, and people are like we were boosting about it that I went, met my family, and I'm full back in action. I didn't know how to contemplate this as a reaction if I were listening to this as a third party, right? That you've just reversed the script. You go to your family to relax, and then you're going to work, and you then again get stressed up. So I think all of us need to figure this thing out, that don't forget the living part, right? I've seen people having insane amount of leaves and not taking it. I don't know why. Like I have also been guilty on that part, but I think we need to start taking those breaks, right? Because when you take breaks, suddenly you're actually having better ideas than normally. You have more energy to perform than normally, rather than spending 12, 13 hours not doing anything, getting burnt out. I think this is a fresher way of rather being more productive, in my opinion.
No, 100%. That's a great point. I think everybody needs to take a break, and the whole point that you made, that you are living to live, right?
Yeah.
Yeah, you're working for a reason, and yeah, I think really thinking about that very deeply is very important. That why are you alive and why are you living, and
Yeah.
what is your goal with life, and what is the goal with the business that you're building, etc., etc.
Yeah.
Stress is gonna come in the way. A lot of work is gonna come,
Yeah.
and you'll probably have to go through that to reach the goals that you want to.
Yeah.
But that does not mean you can't still live in the present and maybe
Yeah.
pursue the hobby, be the people that you want, and
Yeah.
do the things. It is all possible. There are people who've done it. There are people who are still doing it, who will still do it.
Yeah.
It all comes down to how you allocate your time and your energies the right way.
Yeah.
Maybe if a specific habit is taking a lot of that away. For me, my phone used to be the biggest
Yeah.
culprit of
Distraction.
stealing my time. Then you got to sort of put that into control, and everybody has their own ways that they'll figure out, essentially.
Yeah. Yeah. One last thing for the day, and we'll call the session off after this. If you were, say, in like your early 20s again, right? Like, say, 24, 25, what was that one piece of advice you would give to your younger self that, hey, do this would be better for you?
To stay insanely curious and upskill all the time. Just learn new things. I think learn more about technology. So everybody, I think nobody has an excuse anymore not to know how to use at least AI. Like when I was 24, a very long time ago. But in today, if I was 24 today in 2026, my advice would be just learn how to use tools, learn how to build agents, but upskill about other things as well. Like, don't be tunnel vision to only learning how to use a tool, but don't have context about many other concepts.
Yeah.
But also learn about many other topics around that. So a lot of people just learn about tools, but they don't know how to use it. So that requires
Yeah.
you to and stay creative. So build that creative muscle as well. So
Yeah.
curiosity, creativity, and the ability to use tech can sort of solve any problem for you, right?
Yeah.
I think that is something that I did not have too much of when I was 24, and I wish I did. But yeah, that's specifically what I would want.
Makes sense. Makes sense. With this, in no time, we're at the end of the set. I keep repeating this like a broken record. It was just free flowing. Thank you so much, Dikant, for doing this. Thank you for people who've kind of attended. If you all have any questions later on, also feel free to just kind of drop it in comments. Dikant would we'll make sure that one of us kind of answers it on behalf of Dikant. And yeah, thank you so much for joining again, Dikant. Beautiful
Thank you,
session.
Krishna. Thanks for anybody who's joined this, and thanks. Have a great weekend, folks.
Yeah, long weekend था ना, तो I guess लोग already वो mood में ही होंगे.
Definitely.
Yeah.
Cheers, Krishna. Bye.
Yeah. Thank you. You take care. I'll just end the screen.